So in this chapter, we will see the classification of accounting. What are the parts of the accounting, right? Here in this chapter, we will see what is the divisions of the accounting. Okay. Here, accounting can be divided into two divisions. That is, one is financial accounting and other one is management accounting, right? These two are very very different accounting methods adhered by the companies. So we will see what is the purpose of financial accounting and what is the management accounting. Okay. One is purpose. Financial accounting is required by law once a year to be prepared and presented to them, right? Because in all the countries, not only the Sri Lanka, in all over the world, the financial statements has to be prepared by the entity and has to be submitted to the relevant governments on or before the stipulated time. Okay, that is why required by law once a year. Management accounting, management accounts to help management to run the business, right? It is prepared to help the management. The people who are in the management need this information, right? What is the cost of the production? Okay, what is the cost of the product? Then markup, how much they can keep the markup, and what is the selling price. They can determine the selling price using the management accounting only. They can determine all those factors. Timing of course, for the financial accounting, law required once a year. The financial statements has to be prepared once a year, required only once a year. But management accounting usually prepared monthly basis because they want to ascertain their position. So the management accounting usually prepared monthly wise. And requirement, financial accounts required by law, right? Statutory law. Okay, whereas management accounts, no legal requirement. You can prepare the management accounts or not. Nobody is bothered, right? But management is bothered. Okay, not the external parties or government or the owners. But management is bothered about that. Layout in the sense how the design, how the in the way how it has to be prepared, rules and regulations. That is the layout. Whereas in the financial accounts, required by law, it is governed by the law. Each country, it's law. And IFRS, International Federation of Regulations. In IFRS, required by the law and IFRS guidelines. It has to be prepared. But in management accounting, whereas in Sri Lanka accounting standards, according to Sri Lanka accounting standards, not IFRS as well as the accounting standards, we had to prepare the accounts. Whereas in the management accounting, whatever layout that is useful to the management, whatever the layout that is useful to the management. Okay, there is no specific layout there. In such a way you had to prepare the management, this is the way you had to prepare the management accounts, nothing. Okay. Reporting, uh, financial accounting is reported to the external parties in the sense to public, government, and potential, we have seen earlier, potential investors, manage customers, etc, etc. Okay. But in whereas in management accounting, reporting is done for the internal use, that is used by managers. Okay, that is to be used by the manager. Okay, next we will see some definitions and try to understand the terminology used in the financial accounting. Then it will be easy for you all to follow my lectures easily. Okay, so some terminology that are used very frequently in financial accounting we can see now. The first one is assets. We use a few terminology: assets, expenses, liabilities, equity and capital, revenue. Those terminologies. We will see first of all. At first, we will say assets. What is an asset? Okay, an asset is a resource, right? Okay, an asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow into the entity. Okay, that means an asset is a resource controlled by an entity. Controlled. Okay, controlled. Okay, an asset is a resource controlled by an entity as a result of past events, as a result of past events, and from which future economic future economic benefits are expected to flow into the entity. Okay, in this way, in this case, uh, controlled by it can be either purchased, okay, ownership, owned by, okay, owned by, or leased by. That is what we said, controlled. Okay, controlled by. Assets, you may know assets can be defined. Assets, we can say building, building land, building, all those are assets. Okay, vehicles are the assets. So those generally all the people knows what are the assets. Controlled by, only I have to explain to you, that is owned by in the sense you would have purchased it and owned it. Okay, you have all the uh, legal documents to possess that particular asset. Whereas leased, also you are controlling interest, you have the controlling interest, but until you are finishing this leased agreement, right, get the ownership. So leased and owned both can be said as a control by an entity as a result of a past events. Past events in the sense, you would have purchased it in the previous month or previous years, and thereafter the you can generate income flow comes from the those purchased assets due to those purchases. Okay, machinery you used to purchase. Okay, if you have purchased the machinery last year, that is an asset to the company and owned by you. You would have purchased by your own, utilizing your own cash, or you would have leased out. Okay, that can be. So anyway, that will be treated as your asset, and using that machinery you would have done lot of productions, right, productions for the for your ordinary sales activities. So that is generating income. That machinery is helping to generate your income in your course of business. So that is the explanation. Past events and from which future economic benefits are expected to flow into the entity. So that is flowing into the economic benefits are coming to the company for the purchases done in the past, machinery purchased in the past. Okay, and if you are purchasing machinery this year, that also will be treated as a asset, because you are expecting in the future the production will increase and income will increase, sales will increase. Okay, so that will be treated as an asset. Okay, then we can come to the second terminology, expenses. An expense is the cost of operation that entity incurs to generate the revenue and from which no future economic benefits are expected. No future economic, no future economic benefits are expected. Okay, and expenses. Okay, and expenses in the sense you are buying some you are spending for the salary. Okay, administrative people's salary. Why, that is expenses. The cost of operation, the expenses, the expense is the cost of operation that an entity incurs to generate the revenue and from which no further economic benefits are expected. The salary for the administrative staff spend is an operational activity, and that is not directly spent with the production. Okay, with the administration, the expenses spent for the staff not going to produce you or not going to deliver you or future economic benefits, right? If you say this year you are 2024, you are spending 1 million for the salaries, salary. Okay, salaries from which you cannot expect future income flow. Okay, in 2025, for this expenditure not going to produce any sort of uh, revenue or economic benefits, going to bring any sort of revenue or economic benefits in the year of 2025. So we cannot treat these type of expenses as an assets. These has to be categorized under the expenses. Okay, that is what we have said here. An expense is the cost of operation that entity incurs to generate in revenue and from which no future economic benefits are expected. Very good example is salary paid to administrative staffs. Okay, for those people, without those people we are not going to without the administrative people and without the people persons who are in staffs involved in the sales and development activities, the people, the staffs involved in research, without them we cannot expect revenue to the company. But the expenses spent on them on the particular period not going to produce further income, or we cannot expect further economical benefits from that expenditure in future. That is what the expense. So we can come to, okay, right? Then liability. Next terminology is liability. Very often we next terminology is liability. Very often we use this. A present obligation for the entity. Okay, present obligation. That means we are liable. We are liable. That what's obligation gives the meaning. The present obligation of the entity to transfer an economic resource as a result of past event. This is 2024. This is, we can say, financial year 2023, right? The present obligation of the entity to transfer an economic resource as a result of past event. In year of 2023, we would have, I think, not would have, we have assumed that we have received and loan worth of 100,000, okay, from A. We received and we have accounted for that in 2023, right? As a result of past activities we have received in 2023, but in 2024, if we have not yet paid or if we have not settled that amount, this has to be treated as liability in your set of accounts, okay, in your balance sheet. You have to treat this as a liability. Because why you have, because you have, you can say in 2024 or 2024, end of the 2024, or you can say this, you can take this example as a 2024 end of the year, end of the financial year, and this purchase this loan received in 2024 in January or something like that, also like that, okay. But to understand properly, I have taken a different financial year for you to explain, okay. So 2023, we have received 100,000 worth of loan from A, and it has been accounted in the set of books of accounts. And 2024 also, still not, if it is still not paid, it has to be recorded as a liability. In 2023 end of the year also, it has to be accounted as the liability, because if it is the past event, means even yesterday is the past event. Yesterday it's a past event. Even uh, I think if it is now 8 o'clock in the morning, if that the purchase is done in the 7:30, if you say 7:30 a.m., it is past event, okay, due to past events, okay. So it has to be treated as the liability, because it is an obligation. Then we can come to the portion equity capital. Equity capital. Capital means it is the residual interest in the total assets of the entity after deducting all its liabilities. Okay. It is the residual interest. Okay. It is the residual interest on the total assets. On the total assets of the entity after deducting all its liabilities. After deducting all its liabilities. It is the residual interest in the total assets of the entity after deducting all its liability. It is the, we can say, the owner is eligible. Owner is the person who is attributed to equity and capital. Okay, it is the residual interest in the total assets after the deducting all its liabilities. I mean, all the assets are belong to the company, liabilities are belong to the third parties. So after settling all the liabilities from its assets, whatever it is remaining belongs to the owner or partners or shareholders, can be distributed among them. That is the equity or capital. Okay, assets, this here you can say asset minus liabilities. This equal to residual value. Residual value. This residual value can be distributed among the shareholders funds and owners and partners. Okay, assets after deducting the liabilities only. Okay, without paying off all these liabilities, you cannot directly distribute the asset amount to the among the shareholder funds. Okay, that cannot, it is prohibited, it is not allowed. Okay, next terminology we can see into the revenue. Revenue, what is the revenue? It is the uh, frequently used terminology, revenue, expenses, and so on and so forth. Revenue, it is the gross inflow of cash, receivables, or other consideration arising in the course of the ordinary activities of the business. Revenue, it is the gross inflow, it is coming into the company, it is coming to the entity. Okay, it is the receivable, received and receivable, you can say. Okay, it is the gross inflow of cash, receivables, or other consideration. Cash, receivables, and other consideration, in the sense you can say exchange of goods also, you can say. If it is not exchange of goods also, you can say other things. Credit amount, you are granting the goods on credit, you are issuing the goods on credit, then amount receivable is treated as a receivables also coming under the other consideration. Exchangeable goods also coming under the other consideration. That is exchange of goods, in the sense not the goods, the money value of the goods coming under the other consideration. Okay, arising in the course of the ordinary activities of the business, or it should arise uh, during the course of the ordinary activities of the company, not extraordinary activities. It should not be the extraordinary activities, ordinary activities of the company. I mean, if you are in the business of producing and selling the computers. Okay, computers, okay, this is the your trade activity. It is the gross inflow of cash, receivables. Okay, cash, receivables, and other consideration, okay, arising in the course of the ordinary activities of the company. Ordinary, this is the sales activity, this is your trading activity, right? This is your main trading activity, selling computer sales. sales. That is the main trading activity. Okay, then if you are selling the computer, okay, on cash, you can sell on cash, and you can sell it on credit basis. Okay, both both will be accounted as an revenue. If you are selling at the cash, under the cash, it is the sales revenue. If you are selling on credit, it is also will be treated as the credit. If you are selling the scraps, I mean, uh, what you call obsolete, not obsolete stocks, we can say sales of scraps. Okay, scraps, sales of scraps. It is not an ordinary sales. Okay, it will not come under the revenue. It is not the sales took place under the ordinary activities. It is an once a year or once in 2 years only this scrap sales take place. Then you will treat this in the accounting statement other revenue. Okay, other revenue. Right. Right, this is the other revenue. Scrap sales and other extraordinary sales, all those stuffs will be treated under the other revenue and other revenue, assets, expenses, liabilities, and equity and capital, revenue, other revenue. All of these terms you would have understood, I hope, and we will see you all in next chapter. Thank you. Bye. Don't forget to subscribe. Okay.